Good evening, good evening. Good to see everybody. Happy Tuesday, tail end of January. Going by fast already. We'll give it just a minute or two to let everybody get situated, get their audio turned on. It's good to see everyone. I'm excited to get on this. I was looking through the slides a little bit. If you've been through your trading plan once, but you're still struggling with a little bit, I think this is a helpful way to break down into building blocks, right? The organizational structure of what are the pieces of what we're putting together here, defining and trying to make as consistent as possible. Hi, Perry. Good to see you. Good evening, everybody else. We'll give it just about one more minute here. Thank you, Stephen, for letting me know. Taking a little bit of a hiatus. I hope that you have a great time. Stay safe. All right. Let's dive into it. Officially welcome out to the Trading Foundation's Tuesday night class. Today we're talking about trading systems, strategies, and rules. Part 1. This is a two-parter as we look at the hierarchy and structure that creates the foundation for our decision-making, the matrix we progress through in order to be as consistent and as objective as we can. The idea here is we do this work, we build the systems, we define or we develop the strategies, we define the rules. That's going to be off hours, right? We're not doing this during trading. Trading's about execution. Afterwards, we're evaluating our execution. We're evaluating the thought process and the mechanisms that we've developed to say, do they need to change? And if they need to change, we change them. So this is off hours, meaning it's professor work. The professor sits down, the chimp is taking a nap, and we can be rational and logical. We can be very deliberate in defining and making them as concrete as possible so that when we are in a situation where the chimp is up and inactive, we want these rules, this structure to be what really pushes us through. So, all right, let's jump in. Part 1, like I said, my name is Scott. I will be your host. Here are disclaimers. As always, this is educational and illustrative. We're not advisors. That should be the perspective that you look at what we do under. Here's our agenda. We're going to define broadly what trading system strategies and rules are. Then we're going to get into the more granular level. What is a trading system? How do you develop one? What is a trading strategy? How do you develop one of those? How does your strategy fit within the construct of the system? We'll talk about trading rules and their importance. We'll talk about common mistakes that can occur in systematic trading, or at least in our ideal execution of systematic trading and what we might face as obstacles. We'll look at some best practices, and then we'll wrap up session 1. That'll lead us into Tuesday's section 2 of the same systems, strategies, and rules. Please, I try to leave a few minutes at the end for questions. So if there's like a market question or something about this, we'll have some time. But ask your questions as they come up. It's easier for me to try to address them. It's easier for you to remember and me to be like, okay, what's the context of the question? So even though I'm going through a deck, I do want this to feel to some extent conversational, or at least that there's some level of interaction. So hit me up with questions, comments, and we'll go from there. All right, let's dive in. Trading systems, strategies, and rules. A trading system. That's the broad hierarchy. You'll notice that we do everything in this fashion. We have this hierarchy. It's just like when we do market forecasting. What do we do first? The broad market, institutional trend, followed by trading trends. And then we look at, well, what's the components? Then we look at the major market components and the sectors. Then from there, when we've identified strength in the sectors, then we dive in and we find the groups and then the stocks, right? We work our way down following the money. It's all about the hierarchy, and that's makes it easier for us to always know how we identify what it is we want to trade. If you want to know what to trade, find what the institutions are putting their money in. That's what's going up. They have a lot of money. They can make things go up. We can't really make it do anything. So in this regard, the hierarchy is first and foremost the trading system. That's the structured framework. We use that to make systematic decisions about buying and selling. What does that mean, systematic? That means like risk management. How much total risk? How much risk per trade? How many trades? That's systematic. That's being evaluated on a system level. The amount of risk we take, the number of trades we take, that's going to be correlated to our current market posture. So it's always going to be dynamic. Those things are correlated. So that's part of our system. Our system says first analyze the market, understand what these conditions are, then start to break that down into the risk. The other things that are systematic rules would be things like, do you anticipate a trade? Sometimes yes, sometimes hell no. Right? Are you more aggressive or more conservative in the tactics that you're implementing? Meaning how quickly you tighten your stop, how close you tighten it. Do you sell? Do you sell at the previous high or a little higher? Do you sell half or only a third or a quarter? I don't want to have to. Those are systematic decisions. And so what allows me to have those decisions being made is the basic framework that we build with market posture leading the way and establishing the context that then we have the ability to implement our strategies. Right? That's how we implement our strategies. Our strategies are built of rules. Right? We have trading rules in a lot of different places. We have specific risk management rules. We have trading rules. We have routine rules, record keeping rules. We have different things that we do to standardize, and that's what the rules are trying to do, is create standardization. But that's the first part, is the system. What do we buy and sell? What are our entries and exits? What is our risk management? How are we going to do it? You'll notice that trading system is what we're working on when we're working on our trading plan. Then we have our trading strategy. Our trading strategy, that's when we start to get a little more granular into the details. So that's where we get into the execution. In our framework, in our structure, that means section 3. Section 3 is where your strategies exist. Bounce strategies, breakout strategies. Even within the context of different trading strategies, we have sub-strategies, which are our trade management tactics. Do I take profit? When? How much? Do I tighten my stop? At what point? And how closely? Those are our strategies. That's what we're working on when we're working on section 3. We're specifically outlining entries, exits, the analysis methods, all the execution. Then we move to rules. What are trading rules then? So rules can exist within the strategies, but they can also exist within the system. but we have market posture rules. That's not its own strategy. That's a process and an analytical process, but there are rules for how we do that. So those are the directives within a system or a strategy that guide our actions specifically. The better we define the rules when the professor is at the computer, the less likely it is that the chimp ever gets to take over, right? The chimp panicking, the emotions, smashing the keyboard, right? If you haven't noticed, I've really adopted that metaphor quite a bit because I think it makes a lot of sense. So these are the things that govern this, the specifics of position sizing, of exact criteria for entries for exit, what signal, what candle, what indicator has to do what. What this is doing is ensuring disciplined and consistent decision making. So those are the three core components as again, this always goes back to the same thing, right? Successful traders do what failing traders don't want to. And to break that down further, the way that I express it is this: if you treat trading like a hobby, I've said this before, it will pay you like a hobby. If you want it to pay you like a business, then treat it like a business. And I don't mean by time, I mean by commitment, by process. Our trading plan outline looks a lot like a business plan outline in the way that it's defining everything that needs to be in place for us to have an expectation of success. These are the components. So I think for us to be more comfortable, the process of developing a trading plan is an eating an elephant type process. A lot of people shy away from it because they're just overwhelmed. Oh, I'm never going to be able to do that. When all we have to do is just take one bite at a time. That's why we break it down into 8 components each week. We're working on this. What I want to do is give some specific verbiage to the different components that you're working on. So that as you're working on your trading plan, you know, okay, I'm building this strategy. I'm putting these rules in place. This is more systematic, and you see how this puzzle fits together a little bit better. Okay, so what is a trading system? Let's get a little more granular with each of these components. Definitionally, a trading system is a structured framework that traders utilize to make informed and disciplined decisions when buying, selling, trading, investing. It encompasses a set of well-defined rules, criteria, tools, procedures. It's the business plan, right? As you look at the system, you're looking at all the components of the system. What's the first component? You're the first component. We take psychology seriously here. It's a big deal. Section 1 of our trading plan: who's driving the ship, right? What's the executive summary? Then we look at the prospects of what we're doing. It starts with the market, and in the market we do a top-down approach. Then we get to the rules. We start to talk about our rules, and then we have the hierarchy of what governs those rules. We have our risk management. Then we have what governs our actions day to day. Those are our routines. Then we have the analytical. How do we keep records? How do we analyze those records in order to produce the feedback that gives us a clearer idea of, is this right? Is this working? And then it allows us to have the ability to set specific goals that then look to improve the process, continuous improvement. What's the key distinction? So what sets a trading system apart is its systematic nature. We have to have the structure, right? It's like our philosophy is built into what's important, what's prioritized. That's all in context with the trading system. So unlike just a purely discretionary system, and I'm baffled at this point, and I would hope that a lot of you are starting to be like, yeah, how are you making decisions if you're not looking at what we're looking at? If you're not realizing that institutions are 90% of the market, and that what they do is what creates the momentum that we ride. That's our objective as short-term swing traders. If if you're not following that, what are you following? What's the methodology that leads you to make decisions? And I'm baffled, right? When I'm thinking, well, what's the structure? What are you using exactly? So we want to have a predetermined plan in order to enhance our consistency and objectivity. Of course, we recognize there's always going to be levels of subjectivity in our trading. But we want to make sure that even at those instances, we're very consistent in the process we take to analyze and the decisions that we and ultimately come to. The importance of systematic trading, its ability to reduce emotional biases, its ability to keep the chimp in the cage, first and foremost. It helps improve our risk management. We want to be as consistent as possible as we manage risk. And it increases the potential that you have consistent and reproducible results that you're able. This is shampoo, rinse, repeat. Are we doing the right things over and over and over again? We rely on the systems to establish a clear and rational approach to the markets. And it enhances our ability to adapt to market conditions. And that's certainly another core philosophy that we have as traders. That philosophy of adapt or die is built into our trading system. What are we adapting to? Changing market conditions. How? Because our market posture reassesses on a weekly basis. Every week, we look for, is something changing? What does it mean? We have had, I would say, a pretty remarkably accurate record. You can go back, you can look at our posture, you can look at conditions, you can see, do we think we have a crystal ball? Of course not. Do we think we have a great methodology to be doing the right things in the right market conditions? And that's all I need. That alone is going to give me increased confidence in the entire plan that I'm building. Okay, so now we have that hierarchy in place, that system, the beliefs, the philosophy, the underlying structure. Then what do we need? Well, we still have to buy and sell. I've got to buy and sell. I have to know when. Right now, I already want to have my risk management in place before I talk about entries and exits. I want to have my psychology managed. I want to have my record keeping I want to have that foundation, right? The trading system is the cement. Pour it deep and strong. Strategies is the house. We all have different houses, bigger, smaller, colorful design, right? We all trade to some extent a little differently, but it's all can be achieved successfully if the foundation is strong. If the foundation is strong, I don't care what strategy you build, it's going to fail. I mean, period. It will fail. If you don't have that foundation in place, no strategy works without the foundation. That's the point. That's why we really emphasize this hierarchical structure. So the system is the structured, no, wait, did I already do system? Strategy, sorry. On to, did I miss something here? Boom, boom. Okay. Oh, sorry. Yes, let's move on to strategy. Trading strategy is a specific and systematic plan that we employ to guide decisions. So this isn't the guide the thought process. These are the actual decisions. Now I have to have setups. I have to have triggers. I have to have mechanisms to help me develop where's my stop loss and where's my target and where do I take profit? How much do I take when it gets there? And when do I tighten my stop and to what level? And how do I manage the trade through the end of the moment? Those are my trading rules. Those trading rules create my strategies. So each strategy will have its own set of rules. I might have a bounce strategy where I'm looking for trades that are bouncing off of support or resistance. I might have a breakout strategy where it's breaking through. People have a lot of different technical strategies, moving average crossovers, Bollinger Band breakouts. There's any number of ways, right? A lot of different ways that we could build strategies. Again, we can only build those strategies if the system, if the foundation's already in place. So what are we looking for? Well-defined rules for entering and exiting positions, selecting assets, utilizing various analytical techniques. particularly for trade management. That's what you're doing in section 3 of your trading plan. You're defining your trading strategies. Each strategy is a product in your business. A hedge strategy, right? You know, I love to hedge. I have an entire set of rules for how do I hedge, an entire set of rules for how I do bounce trades, an entire set of rules for how I do continuation trades. You guys know I really don't do breakout trades. I wait for it to bounce. So, what's the key distinction here? The distinguishing feature of the strategy is its specificity and purpose. The system provides the overall framework. The strategy focuses on the detailed tactics that drive individual trades. It's the how, the rules of execution. The role of strategies in trading. Trading strategies provide a structured approach to achieving your trading goals. They help you navigate the market, manage risk, capitalize on opportunities with a repeatable plan. We take the time to build these magnificent trading plans, and then we make sure that they are consistent and repeatable. So like I said, they can be based on technical analysis, possibly fundamental analysis, quantitative analysis, whatever it is. You know, there are a lot of different ways to build strategies. If already in place is the strength of the system. Okay, so developing a trading strategy, what are the components? When creating a trading strategy, it's essential to define its key components, which include precise entry and exit conditions, risk management rules, specific technical or fundamental indicators, right? What are you using stochastics? Is it a 7-3 stochastics or a 14-5 stochastics? Are you using MACD? Do you have both? If so, what are they doing, right? We have to be very specific defining the role. The role sometimes of an indicator for me is simply perspective, where I'm like, oh, that's interesting. Whereas some others have a very specific entry and exit role. If the 7-3 stochastics rolls over and crosses to the downside, I exit the trade, right? That's a eject button signal for me. So those are the things that we're looking for when we're thinking about the trading strategy. What are the specific aspects that you can execute from day to day? These are a clear blueprint for trade execution. As you're analyzing markets and executing trades, you want to develop a strategy that involves a thorough analysis of market conditions, right? This is actually part of the system, providing additional information to the strategy. We look at trends, economic events, indicators. Once the strategy is in place, we have what we need to make informed decisions. It aligns with the systematic approach, with the core objective of maintaining consistency and discipline. Okay, so we've talked about the broader components, the system, that's the overarching structure. Then we have the strategy. So the system is kind of the business plan. That's the operating plan. And then the strategies are the individual products, right? Each product should be assessed and evaluated for profitability, for the ability to improve. We make sure that we have a very specific action plan in place for every strategy that we trade. But as we're building these strategies and systems, we just want to make sure we pay heed to trading rules and their importance. So first and foremost, let's define trading rules. They're the backbone of our trading system and or strategies. They are the clear, specific directives. Clear, specific directives. Those are your trading rules. They're not ideas. They're not suggestions. They're not somewhat ambiguous suggestions. That sounds terrible for trading. Clear, specific directives for every aspect of the trading process. If there's something that I'm doing, I should be able to standardize that action and then repeat it over and over and over again. And remember what I say, never get bored doing the right things. Execution, execution, execution. These rules encompass criteria for entering, exiting, managing, controlling risk. They encompass criteria for how we analyze the market, for what we do in the morning before it opens, what we do during the market, what we do after the market, for how we keep records, for how we analyze our records, for how we set goals. It's all rule-based. Everything is rule-based. Actions are rule-based. Decisions are data-driven. You can see when we put it that way, there's not a lot of room for the chimp to come into example. An example of a trading rule, Sandy, you're asking for, is that right? So, for example, a trading rule would be in a system or in a strategy where you say my risk per trade is 1.5%. 1.5%. You say that your setup is in an uptrend after a higher high with a consolidation. That's your setup. Your trigger would be, or you could even go further and define the setup with a doji or some kind of an indecision candle. But your trigger, that's specific. What am I looking for? I need to have price flow exceed the prior day's high, and I need my stochastics to turn up. Stochastic 7.3, the K line turning up. Those are some specific rules that would define exactly when do I shift, right? When do I take a specific action? Our rules are what chart we look at for long-term analysis, short-term. Those are all trading rules. It's anything that provides a directive for what you're going to do or how you're going to do it. Right? There's a rule. The rule should incorporate both what I look at the VIX and how I analyze it for lows and highs. I'm looking to assess escalation or de-escalation, right? So that's what every trading rule, we should be able to ask that question. What are you doing with that trading rule? How are you doing it? And a third question would be why? Why are you looking at the VIX? Oh, because it provides me phenomenal insight into institutional sentiment. Great. Sounds good. So if you have a rule and I say, hey, tell me about that rule, I would want to know, what are you doing with that rule? What is it telling? What directive is it giving you? Then I want to see if you know how. Is it clear? How are you going to achieve that directive? And then lastly, why? Do we understand? If we don't understand why we're doing a trading rule, that rule is now significantly more likely to be broken. If you want to follow your rules, you make sure that you have those three questions asked and answered for every one of them. What am I doing? How am I doing it? And why am I doing it? Trading rules. Thank you for the question, Sandy. I appreciate it. What are the guidelines for entry, exit, and management? Trading rules establish a set of guidelines that we can follow to minimize emotional decision-making. They ensure consistency in trade execution. That's the only way. You're kidding yourself if you think that you can consistently manage your risk without that in place. By adhering to well-defined rules, we can maintain discipline and improve the probability of success in the financial markets. Let's talk about some common mistakes in systematic trading. What are they? Now, here's the deal. These common mistakes are just 3 from our list of 10. Remember, we have the document in your welcome docs, top 10 trading mistakes. These actually, I'm not sure if over optimization, but even if you go look at those, you're going to realize that those mistakes, any of those top 10 mistakes, you're going to be addressing them, mitigating and hopefully eliminating those mistakes through this process and this organizational structure. So lack of discipline. That's probably the most common mistake in systematic trading, is lack of discipline. We deviate from the predefined rules allowing emotions to influence the decision. What happens? The chimp breaks out of the cage, starts panicking. Oh my God, if I don't sell it right now, the market's gonna take it away from me. And the chimp starts smashing the keyboard. And when it's all said and done, you're looking around, you're like, what just happened? And yeah, lack of discipline. Inconsistent, potentially costly outcomes. As I said, you want to have discipline, you need to truly understand the rules, which means a lot of times people know the what and the how, but they lack the why. They lack the motivation. Why am I doing? Why am I doing this? If you understand the why, I think we're much more apt to execute successfully. Second, over optimization. So over optimization occurs when traders fine tune their trading system to historical data to an excessive degree. They're like, oh, well, last year in April, this happened, or last time this happened. Well, yeah, great. We look at cyclical data as a component and we say, yeah, you know what? The cyclical narrative supports the current overall market posture that we have. Great. But we certainly don't overemphasize any one component. In fact, we actually utilize mechanisms to make sure that we don't do that. We're like, well, have you looked at this? We really make sure that we never succumb to inattentional blindness, which is a very common cognitive bias that can happen when we get too focused on one thing and we don't see other factors. It's the frog. It's a frog in a pot of water. We are committed to never being the frog. Steven says lack of discipline can also include overextended trades, too much to manage. Absolutely, 100%. Now, it is good to have a back test to say, yes, statistically over time, if I use these signals, it should work, right? Yes. But look, at the end of the day, you know, if you look at moving averages and you look at a moving average crossover system, guess what? It's going to test phenomenally well in a trending market, and it's going to do terrible in a sideways market. Okay, what does that mean? Well, I mean, you can try to say, hey, if I believe we're entering a trending market, I'm going to put that strategy into place. And if I believe we've entered a sideways market, well, how would I do that? Oh, I don't know. Analyze the market every week, give it a score, see if that helps. Certainly helpful to have that foundation, right? To help us not over optimize, but recognize that our foundation will help us to make sure that we're implementing the right system in the right market conditions, not sticking with your plans. And he said, exactly right. Exactly right. Ignoring risk management. I mean, look, quite simply, if you're ignoring risk management, you've lacked discipline in your trading moves. If you're trading without risk management rules, I don't know what you're doing. Stop it. Stop it right away. That's not what we do. We have those rules in place before we move forward to trade. Risk management is obviously crucial to preserving capital, long-term success, systematic trading. So what are the best practices? Number one, take a bite of the elephant. Develop a well-defined plan. Start with something. I tell people all the time, I don't care if it's one sentence. You're thinking about it, you write a sentence. The next time you come back, you'll be like, oh, you know what? I think I do know what I'm going to start. And you start to flesh it out a little bit more. And your experience starts to translate into being more comfortable verbalizing. What am I doing? How am I doing it? Right? That's our first step. Begin with a comprehensive, well-defined trading plan. You have a template. We work on it every week. You have videos that correspond with every section. Outline your trading rules, your criteria, your objectives. Build the roadmap for executing trades, for risk, for your schedule, for your routines, for your record, all of it. It's all in there. All in there. I promise you will not find a more comprehensive trading plan, particularly when you look at the way we keep records. If you find it, then I will admire it as well. Back testing and forward testing before deploying a trading system, it's essential to conduct thorough back testing to see how would it have done. But more than that, we should forward test, which is paper trading. We talked about paper trading last week. That gives us the ability to validate a strategy or system's effectiveness in current market conditions without risk, with no real skin in the game. Now, again, we've already recognized that the emotions are not the same, but if we commit to paper trading exactly the way we're going to live trade, the way you practice is the way you play. And in trading, the way you practice is the way you trade. Okay. Lastly, we want to make sure that risk management principles ooze throughout our systematic trading. There should be stops. There should be position sizes. There should be drawdown, acceptable drawdown definitions. There should be rules for how risk tightens up if conditions get worse, for how risk expands if conditions get better, for how we may try to optimize risk if we get better and develop a really nice, profitable system. You can never over-define risk management rules, routines, procedures, or processes. You can't. That is your number one job. Every morning you wake up, better manage your risk. You do that, right? Remember what we said about the chess player. What did he say? He didn't say, I'm thinking 6 moves ahead. He said, protect the king. Protect the king. Okay. Summary. There haven't been many questions, so I hope that means it's good. In summary, systematic trading, structured frameworks, predefined rules. What are we doing? We're fostering discipline, emotion-free decision-making. We want the professor to be at the computer, no distractions, ready to go. Trading strategies give us purpose-driven, specific components, guiding our execution and our analysis, right? It makes sure that we are habituating our very specific trading execution. Make sure we understand the role of rules within systems and strategies. They are precise instructions for how we execute. Best practices, make sure you are emphasizing well-defined planning, rigorous testing, effective risk management. Fred says, just need to do it again and again. Yes. Yes, yes, yes. Couple of questions that came through. How often do you review your trading plan? Phenomenal question. And remember what I say, right now, when you're working with the group, we're reviewing the plan in an ongoing fashion on a 2-month cycle. And I say after the first 6 months, you've had 3 iterations. Your first is to get started. Your second is to polish. Your third is, excuse me, your second is to refine. Your third is to polish. By the end of 6 months, you should have a really strong, well-refined trading plan. At that point, I would say, unless you feel like you're really still progressing, I would say it would move to a every 6 months cadence instead of every 2 months. Yeah. Once you get to where you believe it's polished. So once you have 3 iterations of your trading plan under your belt going forward, yeah, you'll spend less time. These days, I probably hit mine once a year. Although, to be perfectly honest with you, I've been doing it more like, every few months with you guys, and it's been helpful. So, I mean, I guess you can't really ever overwork on your trading plan. So that's a great question. Is it normal for a trading plan to change? Well, especially in the beginning, if it's not changing, you're doing something wrong, right? I mean, look, I've changed my plan just recognizing a few things that I've gotten complacent with coming into this group. I was not as diligent with my own. I mean, I work on it, but not with the schedule and the regular commitment that we're doing it as a group. And so my own trading plan right now is improving. So yes, I would expect in the beginning, it changes quite a bit. And then it really starts to be a little bit more subtle, right? Then we start relying on that concept of the aggregation of marginal improvement. At any given time, we're just anything we can be working on improving, we are. Maintain and improve. Maintain and improve over and over and over again. So phenomenal questions. Love it. Thank you very much. Anybody else before we wrap up for the day? Now, remember, we are in a situation right now. The market's a little overextended. We're looking to see if we get a pullback. That pullback will be when we're launching our trade alerts. I told you that we're going to be launching the alerts. Told you we're not going to force. I'm not going to be like, oh, let's trade something to trade something. When it makes sense, we're going to put them on, but those are coming out. So I will send another invitation to Discord to make sure you're on there, because that's where the alerts are coming from. We're very excited about that. Okay. One more question that came through. Oh, this is my final slide anyways to Q&A. Remember that on Thursday, 8:30 p.m. on Thursday, part 2, trading systems, strategies, and rules. And you're probably thinking, how, Scott, how could you possibly have more amazing information about systems, strategies, and rules? Believe me, I do. So don't miss that. Another question came through. Do most successful traders have a plan like you're describing? No, not most. All. All. 100%. I will unequivocally say. Now, could somebody be successful for a couple of months at a time if they caught the right market? Yeah, absolutely. If you're talking about a successful trader, a trader who has spanned multiple markets, they've seen a couple of bulls, a couple of bears, they're a salty dog, they've been around. 100%. They have this plan. I could tell some very interesting stories of where I've seen exactly how this is the way. Not like this is a way that you know, this is the way, right? The foundation that we have allows, because we're putting system first, any strategy come in, any strategy. I don't care. In fact, if you didn't hear this, we have a new group project coming up. We were talking about this exact thought process, that you could have the best signals and systems in the world, but if you don't have the foundation, you're going to fail. And conversely, if you have the foundation, you could take random signals and succeed. We're going to do it. We're going to do it. We're going to do that. I've done it before in settings like this. I'm trying to figure out exactly how I'm going to recreate it. A group project, Steven said, yes, it's going to be amazing. We're going to have some baseline expectations, right? Like liquidity and what type of a stock, right? But we're going to take a group of 50 stocks. We're going to randomly pick 10. Then we're going to flip a coin. Heads were bullish, tails were bearish, right? Now, if we get bullish or bearish, we can also go neutral. We can always go. So I'm gonna put that in there as well. And we're gonna see. Okay, if we built a trade, how are we gonna do this? Steven said you're gonna do it without me. Bummer. We will make that an ongoing, right? That's a great exercise in really testing the merit of your trading. If someone wants to talk about the virtues of their trading, they should be willing to put it to the taste test challenge, right? We're willing to do that here. Yes, absolutely. We won't do it once. We'll make that an ongoing. It's a fascinating experiment. It really is. So anyways, it should be exciting, and it should be a really phenomenal learning environment. And what we'll do is maybe like discuss it on our Discord channel. Again, I'm not going to stop promoting that. We are going to make that a absolutely fantastic ongoing resource for members of the group. So stop hesitating, get in, get comfortable. That's where the experiment will be. That's where the alerts will be. We're on there as a group Thursday mornings and other times as well. So make sure you're participating. All right, listen, everybody. So good to see everybody. Don't forget, tomorrow morning, we're starting 15 minutes before market, like always, with our midweek check-in. We're gonna just kind of see how things are working. We've got a lot of info coming out this last 3 days. We've got earnings from a lot of big tech companies. We've got the Fed. We're not expecting anything from interest rates, but maybe some verbiage tomorrow. We've got some employment reports this week. So, lot to do, lot to see. Make sure you join us for those live sessions. It's great to see everyone. I hope you have a wonderful rest of your night. And as always, happy trading.